Fundsupermart.com.
What is your outlook for Asian equities in 2012?
Well, the outlook for Asia remains very much tied in with what's happening globally. In the last year or so, the correlations of how Asia performs has been virtually with the rest of the world. So what we have on a macro basis, we have the US. Now at the moment, the signs of the US are quite positive. We've got the US showing signs of recovery. There are signs unemployment's coming down, and in fact that growth seems to be picking up. So that's a positive, but Asia is still very much tied to that. Secondly, you've got Europe. Now Europe, of course, has had a lot of problems. It's stabilized at the moment. However, there's still a lot of issues outstanding with regards to Portugal, Spain, Italy, even Ireland, and so on. So again, very important for Asia what happens there. Then we have China. Now China has recently announced that the future long-term growth is going to be about 7.5%, and that to rebalance the economy from being very dependent on investments to consumer, the Chinese economy will have to slow down. So again, that's going to have a big impact on the rest of Asia if that does occur. Then fourthly, we've got politics. Now, in a year where really important decisions have to be made, we're finding ourselves in a position where there's important elections around the world. There's the US, for instance, where we have a presidential election in the second half of this year. We've got China, where we have a leadership transition in the second half of this year. We've got France, where we've got elections. We've had elections in Taiwan. We have elections in Korea coming up, and so on. And again, generally speaking, in a year of election, politicians tend to be very inward-looking rather than outward-looking, and that's quite crucial in a year where so much is happening, where politicians have to make some big decisions. So again, that's going to impact Asia. And then finally, of course, the outlook will depend very much on market sentiment. Now, if you look at valuations of Asia, they're still looking very attractive. On our calculations, valuations are around about one standard deviation below the historical average. Now, we have seen a bit of a rally at the beginning of the year. I think that was partly due to repositioning, as investors realized that they were too underweight Asia at the end of last year. And so they reversed that and went back into Asia. But nevertheless, even after that money flowing in, we're still seeing valuations at attractive levels. So that will create a bottom. But overall, I think the outlook for Asia remains totally dependent on the rest of the world and not what's happening domestically.
So what do you think are the major performance drivers for Asian equities?
Yeah, I mean, again, it's very much linked to what's happening in the world. So for Asia to perform this year, investors will have to feel comfortable that the global growth is beginning to recover, and not just recovering in fits and starts, but it's actually on a permanent trend. Now, there are some hopeful signs with that, certainly with respects to the US. However, there's a lot of pitfalls ahead, particularly in Europe, where, as I've said, we're still very concerned about what will happen with regards to Italy and Portugal and so on. And the other problem with Europe is that they might have stabilized the situation, but no politician is talking about growth prospects, and they have no policies for growth to recover in Europe. And of course, for Asia, that is an important component, given that Europe consists of a significant percentage of exports. And then finally, we have China, where even though we don't expect Chinese growth to be below 8% this year, nevertheless, with the transition happening in the second part of this year, there could be policy paralysis whereby Chinese politicians are reluctant to take the action that's required in a year when there's going to be a change of leadership.
So moving on to the LionGlobal Singapore Trust Fund, this fund has a strong long-term track record. How do you think the fund is positioned in the outlook for Singapore equities in 2012?
We are relatively bullish about Singapore going forward. We think valuations are attractive. We think earnings will recover this year relative to last year. And if you believe that the US will continue to recover, that's absolutely positive for Singapore. Now, for the trust fund itself, we are stock pickers within a macro overlay. So we don't take sector or style bets within the fund. So the way we like to play Singapore is really to focus very much on which stocks we think will help us to perform going forward.
So how much consideration is given to the benchmark when investment decisions are made?
Well, the benchmark is important as much in that we need to be very concerned about where our tracking error is. We are measured against a benchmark when we look at how we perform. And so we have to be very aware of what the benchmark is doing and where we are in relative to that. However, at the end of the day, we do not want to be benchmark huggers, so to speak. We are an active fund management house and a stock picking house, and therefore we are more than happy to take significant bets within stocks that are not necessarily benchmark names.
On the LionGlobal Singapore Trust Fund's latest fact sheet, it appears the fund has 72.6% of its portfolio invested in its top 10 holdings. Approximately how many positions does the fund hold at any one time?
Yeah, the fund on average holds about 30 stocks. Now the top 10 holdings are indeed about 72, 73%. But if you look at the MSCI Singapore Index, the top 10 there is about 67%. So it's not a unreasonable overweight to have. And what it really reflects is because we are a stock picking house, we do take particular bets in those stocks that we really like. And therefore, in this case, we particularly like the banking sector and the offshore marine sector, and therefore the top 10 will reflect that.
The financial sector is the fund's largest sector position at 43.2%. So what are the reasons for the strong conviction in this sector?
Well, actually, if you look at the MSCI Singapore, the financial sector is slightly more at 46%. So actually, we're underweight the sector. But within that, you need to see the financial sector as being banking and property. And so within that, we're overweight the banks and we're underweight property. And the reason we prefer the banks is because if you look at valuations, they're very reasonable. They're trading on a price to book of between 1.2 to 1.3, which is attractive on a historical basis, but also within the region it's attractive. Secondly, we're expecting loan growth to continue to grow, not as much as last year, but there's still going to be loan growth. And thirdly, we expect net interest margins to actually improve this year relative to last year. So all in all, that makes us feel very comfortable about being overweight the banking sector. With regards to the property sector, the property sector's had a good run this year. However, when you start looking at the headwinds, they start to become quite significant. So for example, prices have kept pretty sticky. They're not coming down. That does concern the government. They would like to see prices come down further. Secondly, we have a lot of supply coming online in the next 2 or 3 years, whether it be in the low-cost or high-cost, high-end market. And therefore, those two combinations make us very concerned about the future trends of both pricing and rental. However, what makes us not, even though we are slightly underweight, we're not as underweight as you might expect, because valuation-wise, a lot of that is already in the price. So if you look at NAVs, which is how we think you should value property companies, you'll see that most property companies are trading at sort of one standard deviation below the historic NAV.